Good evening, friends. Hope you are well and doing fine. Thanks for joining this call to discuss HDFC Top 100 Fund. As you may be aware that this is a big milestone day for us. Today, HDFC Top 100 Fund has completed 27 years of its operations. Now, to put things in perspective, if you think of India's population, maybe roughly around 140 crores, and if you see the median age of India's population is roughly around 28 years. And this fund also has been in existence for around that much time, 27 years. So somewhere you can say this is the close to median age of India's population, probably 70 crores or nearly 70 crore people actually have not gone through or not understood this fund so well. Why I'm saying this? That in this 27 years, what this fund has gone through, and its starting point was 96, so it has seen Asian crisis. It has seen when India tested a Pokhran blast, and there were US sanctions thereafter. Then there was a tech bubble. Then there was terrorist attacks of 9/11 in US, followed by global financial crisis and terrorist attacks back in India also at various points in time. Changes in government, Brexit, US-China trade war, even the tension in the European economies, and last but not least, this COVID period. And of course, thereafter, what we saw last year was Russia-Ukraine war, and now what we are seeing is the Israel-Palestinian conflict. So many things have happened. So what at HDFC we follow a simple mantra that while it is easy to make money, what is paramount in fund management is avoiding big mistakes. And that's what we can show you when we see the performance of this fund over the last 27 years. When you see that if you would have invested 1 lakh rupee in this fund at its inception in 96, October 11, 1996, today is worth more than a crore, precisely 1.06 crore. And at the same time, if you would have invested similarly in the Sensex, that is a widely popular, followed benchmark, it would have been close to 31, 32 lakh rupees. So that also brings to the fore that despite so many ups and downs, if a nice stock selection and a prudent, actively managed strategy is followed, then it is possible to generate alpha over the benchmark. And that's what this fund has done for last 27 years. So, active management of a large cap category stocks, top 100 as the name suggests, that it largely invests in the top 100 companies by market capitalization of this country, you can still create alpha for the investors. And we have added nearly 70 lakh rupees over the benchmark returns. And that is a testimony or I would say the fund's performance over the years. But it's not that it had always a straight jacket ride in terms of its performance. So here you can see over before the screen, we have given since 2004 till 2024 YTD September return, and we have compared this fund's performance versus the category average, which is a large cap category average, and as also its benchmark, which is Nifty 100 TRI. So Nifty 100 TRI is available from 2004, and you can see across time period for last 20 years, this fund has done better than category average and probably better than its benchmark. There have been some years where it has underperformed, and for a variety of reasons, which Rahul, who is the fund manager for this fund, will explain in greater detail when we follow the presentation. But what you can see that across the time period, see, whenever it comes to this, a lot of people have a belief, and what I've been seeing or hearing of lately, that actively managed large cap stocks don't outperform necessarily their benchmark indices. But here is a track record before you, which can show that on on a more number of years, you can see more number of greens when you see the performance of top 100 versus the category average. It has actually done better than the category average and its benchmark. That also brings to the mantra that that sound investment plus time plus patience is equal to wealth creation, and that's what this fund has done. As I said, 1 lakh rupee has become more than a crore as on a date for the last 27 years. Even from an investment perspective, which we always have been saying, from a perspective of saying SIP, if you would have done an SIP of 10,000 rupees since inception in HDFC Top 100, today is worth 7 crore rupees. So that also brings to forth a simple point: start early, invest regularly, and stay invested. So what this fund requires, while a lot of analysis goes into seeing the performance in current times over last 1 year, last 3 years, maybe last 5 years, but what this fund has demonstrated over 27 years is that if you stay invested, stay calm across the turbulent period, actually you can create wealth if you are backed by a strong fund management team, strong governance process, and eventually it's a win-win situation for all the stakeholders, investors, distributors, and the AMC person. So on the side that if you see across time period, the fund has generated decent returns. It has given a pleasing experience to its investors who have chose to stay invested for a medium to long-term period, notwithstanding the short-term challenges, but eventually it has created wealth for its investors. So to discuss this journey in a greater detail, as well as what do we expect hereafter, we have with us Rahul Baijal, who is the fund manager for this fund. And Rahul comes with an experience of more than 20 years in fund management and equity research. And he necessarily has the experience of managing large cap strategies in his earlier assignments. He has been with us for last 1 year, but in earlier assignments, he was actually managing similar. So he's a fairly good experience of managing large cap strategies. By training, Rahul is an engineer and a management graduate from IIM Kolkata. And with me also is Ram Kumar, my colleague, who will help me moderate this call. So once again, thank you for joining this call. It's more about Top 100, which has completed its 27 years of its operations. And to discuss its journey and way forward, now I invite Rahul to take it forward. Rahul on the call are our investors and distributors, and they would be more than happy to hear from you. What are your thoughts on this product and how do you intend to take it forward? Over to you, Rahul.
Sure. Thank you, Ashokji. I'll just take 30 seconds to enable my presentation. Yeah, is it visible, the presentation?
Yes, yes.
Okay, thank you so much. Thank you, Ashokji, for the kind introduction. So at the outset, I like to say I am quite excited to be associated with this legacy product. And as Ashokji mentioned, that the legacy is very long, with the long track record of 27 years across various macro and micro crises and opportunities which India has traveled through. And I'm looking forward to the journey ahead. I've taken over the responsibilities from last July onwards, and it's been about 14 months since I've taken over. And I'll spend some time today basically in two parts. Initial part of the presentation, first 10 minutes, I'll spend on the large cap category, giving my perspective on why I think large caps are attractive and why I think, especially in the current environment, large caps are looking relatively more attractive versus the smaller caps and the mid caps in the current environment. And while talking about this, I'll also address the issue of active versus passive debate, which is very hot and live in the Indian mutual fund industry. So these are three questions I'll address in the first part of the presentation. And the second part will deal about the strategy of this product and how it's positioned for the future. So firstly, on large caps, as we all know, these are the top 100 companies by definition, and fairly well-researched universe over the course of time. And these are run by experienced managements, as you know, and they've seen various business cycles over the course of time as they've traveled their journey from small caps and mid caps, and then entered the large cap. Uh, just to give an idea on the return potential, as we all know, it's been a fairly attractive compounding in India over the last 18 years or so. Point to point returns have been close to 13%. And just to give a perspective, one question often comes as to how the correlation with GDP growth is. So actually, if you look at the past 5-year, 10-year long-term track record and look at this table below, you find that the benchmark returns clearly follow the earnings growth over the long term, and the earnings growth, it's slightly ahead of the nominal GDP growth. So for example, if you look at the last 5 years, the nominal GDP growth has been about 10%, and the Nifty index growth has been 1% higher. Similarly, over the last 10 years, the nominal GDP growth has been 11%, and the benchmark returns has been 1% higher. So broadly, very high correlation between the nominal GDP growth and the benchmark returns in India, whether you look at last 5 years or 10 years. Now, what about the returns? I think this is a very interesting slide. While this gives you a perspective on the point-to-point returns over 18 years, but this slide basically tells you how the rolling returns in India have been. And very interestingly, if you look at the rolling returns, whether it's 3 years, 5 years, or 10 years, the large cap index, Nifty 100 TRI, has given a very steady 12% compounding. And also, if you look at the small cap index, surprisingly, it's also given a similar level of compounding, although there are different mutual fund schemes in the mid and small cap phase, including ours, which have been significantly outperforming this index. But this is just to give a perspective on the benchmark kind of returns. And as expected, the mid cap index, as you can see, has given a steady 15% compounding. So an excellent track record has been set in India across the market cap curves, and large cap index has given a very steady 12% compounding, slightly ahead of the normal GDP growth. But why I'm showing this slide is that if you look at the risk adjusted returns and you adjust for the risk by looking at a measure called standard deviation, which is the second last row. Standard deviation or volatility, as we know, in terms of up and down movement, is much lower in the large caps than the smaller names. And then if you divide the average return by the standard deviation, you get something called as the risk return ratio. That, if you see, is the highest across the large cap index across time periods. And this is why it is said in nominal parlance of stats that the risk adjusted returns is the highest in the large caps. And that is one of the main reasons why the FIs find this market cap curve an attractive part of the equity asset class to invest in India. And in fact, around 80% of their entire $700 billion that they have invested in India is broadly invested in the large cap space. So this was just to give a perspective on how the risk adjusted returns are the most attractive in the large cap space. This is a very interesting slide and captures what we have been, debating uh, in the industry in terms of the active versus passive debate. Does it make sense to invest in the active large cap funds? Have they been producing alpha? Or, you know, the common narrative seems to be that, the alpha is missing, but I think it's more of a myth. If you look at the actual data, and this data shows you the large cap schemes over a 1 year, 2 year, 3 year trailing, a lot of schemes are actually creating reasonable alpha. If you look at 30th September 23 ending performance, and if you looked at the same performance 2 years back, the narrative was different. So I think if you look at the last 5 years, what has happened is that initial years in 18 and 19, you had a very narrow rally in the large caps. About 15, 20 stocks were dominating the Nifty performance in 18 and 19. And then COVID happened in 20, which led to a very fast sector rotation in terms of performance. So if you look at the trailing returns in, let's say, 21, which is what we have shown in the right hand side of the table, the 1 year, 2 year, 3 year alpha returns were much weaker. But last 2 years, there's been a broad-based recovery in the economy. A lot of businesses, a lot of subsectors have been doing extremely well. And the opportunity for stock picking has also been a lot more. And we have seen that in the broader market rally post the COVID-19 pandemic, alpha has come back to the category, and not just minor alpha. Many funds, as you can see, have been producing reasonable alpha of more than 2% consistently over time periods. So I think the point here is that in a narrow rally, in a fast rotation rally, it gets tough to produce alpha. But once you have an economy which is reviving and being driven by multiple business cycles across multiple sectors, the opportunity for stock selection is much more. And therefore, the opportunity for alpha creation is also much more, as has been the case last 2 years. And I think over the next 3, 5 years, if I look at the Indian economy, the way it's shaping up, it seems to me that multiple business cycles and multiple sectors will keep doing well. And therefore, the opportunity to create stock picking across a wider band of universe will continue to be available. So that's on the active versus passive debate. And one more point I like to make over here is that even a 2% additional alpha makes a lot of difference to the long-term wealth creation. For example, if you look at, let's say, a 13% CAGR over the long term, let's say over 10 years in a passive index versus a 15% return in an active fund, which produces 2% alpha, you'll find mathematically that the difference in wealth creation is reasonably significant. And you end up having a corpus which is 20% higher than what you would have had, if you were invested in a passive scheme. And I think 20% is a reasonably high number from a wealth creation perspective. So that's the other point I wanted to make in the active versus passive debate. And like I said, there's been diverse performance across sectors over the last 2 years, and I expect this trend to continue. Then coming to the third aspect, which I mentioned, uh, as to why I think large caps are well positioned. So if you look at this chart, this is basically a table which summarizes the annual performances of the different market cap curves in India over the last 17 years. And you'll find that if over the last 17 years, 7 years, large cap index has been the best performing index, followed by the mid and small cap. And in the remaining 10 years, 7 years, small cap index has outperformed, and 3 years, the mid cap index has been the number one performer. So the point is that The market cap curve rotation keeps happening year after year in terms of leadership changes. 1, 2, 3 keeps changing. Uh, but over a course of time, like I have shown in the rolling return style, that if you average out these returns, the compounding is fairly steady when it comes to large caps. For example, it's been about 12% in the index over 3-year, 5-year, 10-year. And given the macro situation right now, my view is that there is a high chance that the large cap outperformance may return over the next 6 to 12 months. And the reason I say this is, one, valuations clearly are more attractive. If you look at the valuations versus the history for large cap universe, a large cap benchmark, it's trading at about 18.5x, which is a 10% premium to its long-term 10-year average. But if you look at the same premium to history, the mid cap index is trading at about 30% premium, and the small cap index is trading at a 40% premium. So the mean reversion theory suggests that at such levels, there is a high chance that reversion happens. And therefore, keeping that in perspective, large caps have a high chance of outperformance coming back in the next 6 to 12 months. Secondly, even from a sentiment perspective, we have seen there seems to be a lot of euphoria in many pockets in some of the smaller names. And usually we have seen when there is a reasonable disconnect between valuations and fundamentals, uh, these are times when such inflection points also happen. And thirdly, if you look at the last 2-year returns in the Nifty 100, they have been very suboptimal. The market is almost flattish. It's given about 7-8% returns over 2 years versus a 14-15% returns which you get in the fixed deposit. So I think from a time correction perspective also, the large caps seem well placed. And typically in a high interest rate environment also, it's usually more favorable for the larger caps. So I think on the back of all these reasons, at least I feel, in my view and my personal opinion, that there is a high chance that the large caps should outperform the mid and small caps over the next 6 to 12 months. So that's the first part of the presentation where I talked about the attractiveness of the large caps and address the active versus passive narrative and why I think the large caps may outperform going forward. Now, coming on to the product, and as you know, the top 100 fund used to be called the top 200 fund many years back for a long time. And then the name changed when the categorization to the large cap happened in 2018. So if you look at the strategy, I think there's a lot of continuity in terms of the strategy. What used to be there before in terms of the blend style continues. It's being managed as a blend of GARP and value, and a lot of focus on bottom-up stock picking, which is blended with the top-down sector and macro trends. And while doing bottom-up selection, I also pay a lot of attention to the company's positioning in their respective business cycles, sector cycles, and valuation cycles. And the portfolio construction is done from a medium to long-term perspective. And the aim is to create an optimally diversified portfolio of about 50-55 stocks, which has been the range over the last 10 years. How I'm approaching GARP and value is a bit different in two ways. Firstly, when it comes to growth and reasonable price, I have a high tolerance for the entry level multiples and the exit level PE multiples, especially for companies which are good quality and where I see that the runway of growth can be long and the companies can have long-term sustainable competitive advantages. So over there, I tend to have a slightly higher tolerance level for the P at the entry and the exit level. And when it comes to value, my focus remains on having visibility of catalysts and high confidence on visibility of catalysts over a reasonable period of time. And the reasonable period of time for me is about 2 years. If the catalyst is not visible, or the visibility is hazy, or it's more of a medium to long term, more than 2 years kind of a horizon, then I tend to be staying away from those kind of value stocks. So that's the tweak when the approach about the approach when it comes to GARP and value style is concerned. So that's about the strategy. Then, as you all know that, like I said before, the large caps come with a lot of lower risk because the managements are well known, the teams are deep and wide and very well qualified. The business models have been tested over course of time, and the risk of implosions are far more lower, which does happen more frequently in some of the smaller names. And the balance sheets are relatively healthy, which makes the inherent risk of investing in large caps quite low. Then coming on to risk management, I think again over here, what continues is that it's falling in optimally diversified style. Like I said, about 50-55 stocks, and the benchmark overlap in this fund used to be a 50 to 65% range over the last 10 years, and that range continues. There is flexibility to take mid caps as well, somewhere in the range of 5 to 15%. And in terms of sector deviations and stock deviations, I'm following an internal framework which is more measured in terms of sector deviations and stock deviations. So that's a bit of a tweak. Otherwise, most of the other parameters in risk management remain the same. So on the back of the strategy which I've articulated and the risk management framework, this is a summary of the changes in the portfolio over the last 14 months. If you look at the second last columns, you'll find that directionally the extent of overweight underweights has changed a bit, but directionally the sectors which were overweight 14 months back, financials, healthcare, utilities, communication services continue, and the sectors which were underweight, consumer discretionary, staples, IT, materials continues. The only two sectors with a significant shift is industrials, where the fund has gone from overweight to underweight on the back of profit booking done because of valuation concerns, while the overall theme still looks good from a medium-term perspective. And the energy overweight has significantly been reduced to more of a neutralish level. But within these sector changes, while the direction may have remained the same, there have been a lot of entry and exits. So around 15 ideas have been exited, and 9 new ideas have come in based on the strategy I articulated and the risk management framework. And on the back of all these changes, this is how the current positioning is like. On one end of the overhead spectrum, you have financials, healthcare, communication services, and the underweight stance is there in mainly in consumer staples and discretionary, and IT and materials. So net, this is what the fund looks like in terms of metrics. Since it's a large cap oriented product, always 80% will be large caps. The overlap with the benchmark, like I said, used to be between 50 and 65%. It's right now at the upper end of the range, as I tend to get more conviction and confidence in the recovery in some of the names. This overlap could decrease over time, and this fund could become more active, let's say 6 to 12 months down the line. And the portfolio turnover ratio has also been very much in the range. 1 year back, it was 15%. and a 10-year range has been between 15 to 30%.
Thanks, Rahul, for a very comprehensive overview of the fund. Of course, we explained the history that it has a great track record. Over last 27 years, it has created wealth for its investors. And given the outlook, it is poised to continue its momentum going forward also.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.